welcome to the Property Wealth Podcast. We're thrilled to have you with us today.
Absolutely. It's great to be here. A lot of residential investors might be curious about diving into commercial real estate, right?
Yes, that's such a fascinating topic. It can seem a bit daunting at first, but there's so much potential for building wealth.
For sure. A lot of folks think commercial real estate is just for the pros, but it's really more accessible than you might think.
Exactly. And today, we'll explore how residential investors can transition into the commercial space, like what to look for, the differences, and some practical tips to get started.
We'll also discuss, the different types of commercial properties and how they can fit into your investment strategy.
And let's not forget about the financing options. That's a biggie, right? Understanding how to fund these investments can make a huge difference.
Right, and we'll touch on common pitfalls to avoid so you don't feel overwhelmed or make costly mistakes.
So if you've ever thought about expanding your portfolio or just want to know more about commercial real estate, you're in the right place.
Let's dive in.
Yeah, let's get started.
So, when we talk about commercial real estate, it's really about thinking ahead, right? Especially for those of us over 40. It's like, what's our retirement timeline looking like?
Absolutely, Mike. I think a lot of people at this stage in life are starting to really consider how they can secure their financial future. And commercial real estate can be a game changer in that regard.
Right, and let's face it, with inflation being what it is, traditional savings just don't cut it anymore. The purchasing power of our savings is slowly dwindling.
Yeah, it's kind of scary, isn't it? I've heard stories from investors who were relying on their savings for retirement, only to find out that they can't maintain their lifestyle on what they thought was enough.
Exactly. I talked to a friend recently. He had a nice nest egg, but with rising costs, he realized he needed to pivot to something more stable, something that could generate consistent income.
And that's where commercial properties come in, right? They often offer more stability and potentially higher returns compared to residential investments.
Yes, and think about it this way. Commercial properties usually have longer lease terms, so you can count on that income for a longer period, which really helps with financial planning, especially as you approach retirement.
Right, and it's also about the emotional side of this too. A lot of people want to feel secure in their financial situation as they age. It's not just about numbers on a spreadsheet.
Totally. There's a peace of mind that comes with having a solid investment that you can rely on. I had another client who transitioned from residential to commercial properties. He said it felt like a weight lifted off his shoulders.
That's such a good point. It's about building that security for not just yourself, but for your family too. Who doesn't want to leave a legacy?
Exactly. And commercial real estate can also be a pathway for wealth transfer to family members. Just imagine being able to pass down a portfolio of properties that are, income generating assets.
Yeah, that's a fantastic legacy to leave behind. And in a way, it's like a financial safety net for them too. They won't have to worry as much about their own financial futures if they have something substantial to rely on.
And let's not forget about current economic trends. The market is shifting, and we're seeing a rise in demand for certain types of commercial spaces, like warehousing and logistics centers, especially with the growth of e-commerce.
Right. There's a real opportunity there. If you can identify the right market shifts, you can position yourself to benefit from them. And that's crucial as we look to secure our financial futures.
Yes, and it's about being proactive rather than reactive. You don't want to find yourself in a position where you have to scramble just to keep up, especially as you near retirement.
Exactly, and I think that's what can be so empowering about investing in commercial real estate. It gives you that control over your financial destiny,
Absolutely. I was working with an investor who was initially hesitant about commercial properties. They were so used to the residential market, but after doing some research and seeing the potential, they made the leap.
And how did that go for them?
Well, they purchased a small retail space in a growing neighborhood. The rental income is solid, and they're already seeing appreciation in property value. It's been a real confidence boost for them, knowing they've diversified their portfolio.
That's amazing. I think that's the kind of story that resonates with a lot of people. It's not just about the numbers. It's about the journey and the growth, both financially and personally.
Right. And more importantly, it's about creating opportunities for themselves and their families. It's a way to take charge of your financial future, especially in an uncertain economy.
Yeah, and it's not just about making money. It's about building a life that you want. I think a lot of listeners can relate to that feeling of wanting stability and growth, especially after 40.
Exactly. When you start thinking about retirement timelines and what that looks like, it's crucial to have a strategy that aligns with your goals, and commercial real estate can fit into that.
It really can. So as we move into discussing core strategies, let's keep those goals in mind. How do we approach this investment journey so it feels both secure and rewarding?
Absolutely. Let's dive into that. So let's dive into some core strategies, shall we? One of the first things I always tell people is to get familiar with the 1% rule. You know this one, right?
Yeah, I've heard about it. It's like if the monthly rent is at least 1% of the purchase price, it's worth considering.
Exactly. So if you buy a property for, say, $200,000, you'd want to see monthly rents of at least $2,000. It's a quick way to gauge if a property could be a good investment.
That's a great starting point. But it's not the only metric, right?
Right. Another important rule of thumb is the 50% rule. This one suggests that about 50% of your rental income will go toward operating expenses. So if you're pulling in that same $2,000 a month, you might want to budget $1,000 for expenses like maintenance, property management, and taxes.
That makes a lot of sense. It helps you keep a realistic view of cash flow.
Exactly. And once you've calculated that, you can better evaluate your potential profit. If your mortgage is, say, $800 a month, you're looking at a cash flow of about $200 after expenses.
Right, so it's crucial to know those numbers before diving in. What about cap rates? I hear that term thrown around a lot.
Great question. The capitalization rate, or cap rate, is essentially a way to measure the return on an investment property. You calculate it by taking the net operating income, which is your rental income minus expenses, and dividing it by the purchase price.
So if a property generates $24,000 a year in rent, and after expenses it's $18,000, and you bought it for $300,000, the cap rate would be...
You'd take that $18,000, divide it by $300,000, and that gives you a cap rate of 6%.
Got it. So higher cap rates generally mean better returns, but they might also indicate higher risk, right?
Exactly. You want to balance that out. A property with a low cap rate might be in a stable area, while higher cap rates could be in up-and-coming neighborhoods or even struggling markets.
Speaking of neighborhoods, how do you evaluate which markets to invest in?
Well, I always say to look for areas with strong job growth, good schools, and amenities. Population growth is a big indicator. You want to see that more people are moving in, which usually drives demand for rentals.
And how do you find that data?
You can check local government websites, census data, or even real estate platforms like Zillow or Realtor.com. They often have neighborhood statistics that can help you gauge trends.
What about property types? Should someone starting out focus on residential or commercial?
It really depends on your comfort level. Residential properties are often easier to understand for new investors. But as you gain experience, commercial properties can provide better cash flow and longer leases.
So like retail spaces or office buildings, for example?
Exactly. But they do come with their own set of challenges, like higher vacancy risks and the need for stronger tenant relationships.
Speaking of tenants, how do you evaluate potential deals?
A good checklist can help. First, analyze the location. Look for the economic indicators we talked about. Then, check the property condition. You want to know if there's a roof that needs replacing or plumbing issues.
That's definitely something I'd want to know up front.
Next, look at the financials closely. Calculate your cash flow, cap rate, and understand how much you can spend on repairs and upgrades. You should also consider financing options.
Right, financing is crucial. What do you recommend?
If you're starting out, traditional mortgages can be a great option. A 30-year fixed mortgage gives you stability with predictable payments. But as you grow, consider commercial loans or even partnerships.
Partnerships are interesting. How do you find reliable partners?
Network, network, network. Attend local real estate meetups and connect with people who share your investing philosophy. You want partners who have complementary skills and a shared vision.
It sounds like building a team is just as important as the properties themselves.
Absolutely. Your team can make or break your investment journey. Now let's talk about common pitfalls.
Yes, please. What do you see the most often?
One big mistake is underestimating expenses. Many new investors focus solely on the purchase price and rental income, but forget to account for things like vacancies or unexpected repairs.
That can really throw off your cash flow, can't it?
Definitely. And then there's the issue of over-leveraging. Taking on too much debt can be risky, especially if the market turns or if you have unexpected expenses.
So keeping a reserve fund is key?
Exactly. Always have some cash set aside for emergencies. It's your safety net. And remember, don't rush into deals.
Patience is a virtue in real estate, isn't it?
It really is. Take your time to analyze opportunities, and don't be afraid to walk away if something doesn't feel right.
That's solid advice. I think it's all about finding that balance between being proactive and being cautious.
Right. And trusting your instincts too. If a deal feels too good to be true, it often is.
That's a good reminder. I think we've covered a lot of ground today on commercial real estate for residential investors.
Yeah, I hope our listeners feel more equipped to explore this area. There's so much potential out there. It just takes the right approach.
Absolutely. Thanks for sharing all these insights, Mike.
You know, Sarah, one of the biggest pitfalls I see with investors, especially those transitioning from residential to commercial real estate, is really over-leveraging. They get excited about the potential returns and just dive in without considering how much debt they're taking on.
Yeah, that makes sense. It's easy to get caught up in the numbers and the potential, but what happens when the market shifts or, when unexpected expenses pop up?
Exactly. I once worked with a client who bought a multifamily building with an aggressive loan. At first, everything seemed fine until a couple of the units went vacant. He was struggling to cover the mortgage, and the cash flow just wasn't there. It was a tough lesson learned.
Oof, that sounds stressful. So how can someone avoid that situation? Is it just about being conservative with financing?
That's part of it for sure, but I also recommend having a solid buffer in place, like an emergency fund. You want to make sure you can handle a few months of vacancies or unexpected repairs without feeling financially squeezed.
That's wise. And I guess it's not just about the debt itself, but also about the kind of tenants you attract, right?
Absolutely. Bad tenants can really derail your investment. If you don't vet them properly, you could end up with people who don't pay rent on time, or, worse, cause significant damage to the property. I had another client who jumped into a commercial property without thorough tenant screening. They ended up with a tenant who was constantly late on payments and eventually had to evict them, which just added more costs to the mix.
That must have been a nightmare. What should investors look for to spot potential red flags when it comes to tenants?
Well, I always recommend checking references, credit history, and even previous landlord feedback. If a tenant has a history of issues, it's usually a sign to keep looking. Also, trust your instincts. If something feels off during the interview process, it probably is.
Right. Intuition can be a powerful tool. What about cash flow? I imagine ignoring that can lead to some serious problems too.
Definitely. I see a lot of investors get so caught up in the potential appreciation of a property that they overlook the importance of cash flow. I worked with a couple who bought a commercial property in a great location, but didn't calculate the ongoing expenses properly. They assumed they'd always have tenants, but when they went through a vacancy period, they were left scrambling.
So it's really about understanding the full picture, huh? What kind of expenses should they keep an eye on?
Well, you've got your typical operating expenses, maintenance, property management fees, utilities, but there are hidden costs too. Things like property taxes, insurance, and even the cost of repairs that might pop up unexpectedly. I always advise investors to run a detailed pro forma analysis before they commit to anything.
That sounds like a smart move. And then there's the whole timing the market thing, right? That can be a slippery slope.
Oh, for sure. I've seen investors wait for the perfect moment to buy, thinking they can time the market just right. But the reality is, no one can predict the market with absolute certainty. A friend of mine waited for months and missed out on some great opportunities because he was holding out for lower prices. By the time he was ready, prices had already climbed again.
That's such a common trap. So what's the alternative? Should investors just jump in when they find a property that makes sense?
Yes, focus on the fundamentals of the property instead of trying to guess where the market is headed. Look for properties that fit your investment criteria, have strong cash flow, and good potential for appreciation, regardless of the current market conditions.
That's such a refreshing perspective. I think a lot of people can get consumed by the fear of making a bad investment, which leads to inaction.
Exactly, and that can be just as detrimental. You really want to ensure you're making informed decisions based on solid data rather than letting fear dictate your moves.
Speaking of data, I imagine understanding the local market is crucial, right? How do you recommend investors get a grip on that?
Great question. I always suggest doing thorough market research. Look at trends in the area, population growth, job market health, and even the types of businesses that are thriving. Networking with local real estate professionals can also provide valuable insights.
That makes a lot of sense. And I suppose it's also about being adaptable, right? Markets can change quickly.
Absolutely. Being able to pivot and adjust your strategy based on market conditions can save you a lot of headaches. I had a client who was set on a specific type of commercial property, but when those weren't available, he pivoted to a different asset class that ended up performing even better for him.
Wow, that's a great example of flexibility paying off. It really highlights the importance of keeping an open mind.
For sure. And, it's also about learning from mistakes. Every investor will face challenges, but those experiences can teach you valuable lessons. It's how you respond that truly matters.
So rather than fearing mistakes, we should embrace them as part of the learning process?
Exactly. If you can approach challenges with a mindset of growth, you'll be in a much better position long term. Just remember, every investor has faced setbacks. It's all about how you recover from them.
Such a positive outlook, Mike. So for anyone listening who might be worried about making these mistakes, what would your advice be for moving forward?
First off, don't let fear hold you back. Educate yourself, build a solid team of advisors, and start small if you need to. Focus on properties that align with your financial goals and always have a buffer for unexpected expenses. The more prepared you are, the less likely you'll fall into common pitfalls.
That's fantastic advice. It really does come down to preparation and a willingness to learn.
Absolutely. And remember, every step you take is part of your journey to building wealth through real estate.
Well said. I think that's a great place to wrap up this discussion.
All right. So now that we've talked about the potential of commercial real estate for residential investors, let's get into some actionable steps you can take right away.
Yeah, I think that's super important. It can feel overwhelming, but breaking it down into smaller pieces makes it more manageable, right?
Exactly. First off, start by analyzing one deal a week. Just one. It doesn't have to be a huge property. You could find something small, maybe a duplex or a small retail space.
That sounds doable. What tools can they use to analyze those deals?
Great question. There are a few apps and websites that can really help. For instance, you can use Zillow for property listings and to get a sense of market prices.
Oh, and I've heard good things about BiggerPockets too, right?
Absolutely. They have a fantastic calculator that helps you analyze potential cash flow and returns. Plus, they've got a lot of resources and forums where you can ask questions and connect with other investors.
It's like a community, right? That's really valuable.
Yes, it is. Another tool I recommend is Deal Check. It's user-friendly and lets you quickly analyze multiple properties, which is handy if you're considering a few options at once.
And what about rental properties? How can someone gauge what they might earn?
For that, Rentometer is fantastic. You can input a property's address and see what similar properties are renting for in the area, which helps you set realistic expectations.
That's awesome. What about local market insights?
Access to your local MLS is key. If you can get in there, you'll find a wealth of information about recent sales, active listings, and neighborhood trends.
And isn't that crucial for understanding the market?
Definitely. Knowing your local market is half the battle. And speaking of knowledge, I'd recommend some books if you're looking to dive deeper. The ABCs of Real Estate Investing by Ken McElroy is a great start.
Oh, I love that one. It's so practical.
Totally. And Commercial Real Estate Investing for Dummies has a lot of straightforward advice. You can pick it up and start implementing tips right away.
And what about podcasts? There's got to be some great ones out there.
For sure. I'd say BiggerPockets podcast is a must listen. They cover a wide range of topics, and you can hear real-life case studies from various investors.
That's so inspiring. Listening to other investors really helps put things in perspective, doesn't it?
Absolutely. And if you're looking for something more focused on commercial real estate, check out The Commercial Real Estate Show. They dive into specific strategies and trends, too.
Nice! So getting knowledge is one thing, but what about habits? What can they start doing today?
Good point. I'd suggest joining a local real estate meetup or investment group. Just being around like-minded people can motivate you and help you learn from others' experiences.
That sounds like a great way to network, too.
Yeah, and you might even find a mentor in those groups. And remember to commit to learning something new each week, whether it's through reading, listening, or connecting with someone.
That's such a positive mindset. It sounds like a journey of continuous growth.
Exactly. And starting small is key. You don't have to jump into a massive deal right away. Just take that first step and then build on it.
So a consistent habit could be analyzing one deal and connecting with someone every week, right?
Right. And don't forget to keep a journal of your learnings and any insights you gain. It helps you track your progress and reflect on your journey.
I love that idea. It really personalizes the experience and keeps you motivated.
Sure does. So those are some practical first steps. Now, let's bring this all together. All right, so as we wrap up today's episode, let's just quickly recap some of the key takeaways from our discussion on commercial real estate for residential investors.
Absolutely, Mike. First off, I think one of the biggest points was understanding the difference between residential and commercial properties. It's crucial, right?
Yeah, and the income potential in commercial real estate can be significantly higher, which is really appealing for anyone looking to build long-term wealth.
Definitely. And remember, we talked about the importance of doing your homework, researching the market, understanding the cash flow, and knowing your expenses. It's not just about buying a property. It's about making informed decisions.
Exactly. Plus, we can't forget the value of networking. Building relationships with other investors and professionals in the commercial space can open up opportunities you might not even be aware of.
That's such a good point, Mike. And lastly, we touched on the financing options available. It's important to know what's out there and how to leverage different financial tools to your advantage.
Right. So if you're over 40 and thinking about dipping your toes into commercial real estate, just remember, it's all about taking those small, informed steps towards building that wealth.
It really is, and you don't have to do it alone. There's a whole community out there, so don't hesitate to reach out.
Absolutely. And if you enjoyed today's episode, please like, subscribe, and leave a comment with your biggest takeaway or any questions you might have.
And share this with someone you know who's over 40 and interested in investing in property. They might find it really helpful.
Next time, we're diving into mobile home park investing basics. Should be an exciting topic.
Can't wait for that. Thanks for joining us today, everyone.
Take care, and we'll see you next time.
Bye for now.